These are the 10 most important tips that every investor should follow in order to become successful in the stock market. My name is Rick. I hope you had a wonderful day so far, guys. And to make it even better, in different parts of this video, I'm going to give you free access to many tools that I created to help you invest and manage your finances. So be sure to not skip any part, subscribe to the channel if you're new here. Let's go straight to the tip number 1, which is don't delay. Are you one of those people that try to find the best moments to buy an ETF? What about waiting for a crash because the stocks are too high priced right now? A recent study by Schwab will help you get a picture. Imagine 5 different investors. Each receive $2,000 at the beginning of every year for the 20 years from 2002 to 2022 and invested the money in the S&P 500. Peter Perfect places $2,000 into the market every year at the lowest price of the year. He was very lucky. Ashley Action invested her $2,000 every year on the first day. She didn't want to try to time the market. Matthew Monthly split the investment into 12 equal parts, investing them every month using the so-called dollar cost average method. Rosie Rotten invested every year at the world's most expensive moment. Poor her. Larry Linger, well, Larry left his money in cash, waiting for the perfect moment to invest. What's interesting is that Rosie Rotten, even investing every year at the worst possible moment, ended up with double as much money as Larry, which didn't invest at all. Remember, showing up is half the battle. Even if you don't invest in all the right things at the right time, starting earlier rather than later allows you to benefit longer from compounding returns. If you want to know how much these benefits from compounding are going to be, you can download for free my compound interest calculator from the link in the description below. Tip number 2. Understand asset allocation. You've decided to start investing. Next question is, how much risk can you take? And depending on this, you set your so-called asset allocation. Asset allocation means distributing your money among different asset categories such as stocks, bonds, cash, crypto, commodities to balance risk and reward. If you're young, you're okay with taking risks and can invest for a long time, you'll go more towards stocks and maybe even some Bitcoin. If instead you're not comfortable with risk or don't have much time to invest, you'll invest in a mix of stocks and bonds, and there is no better way than using the famous 3-fund portfolio. 1 part US stock market, 1 part international stock market, and 1 part bonds. You can download for free this Google tool that I created by scanning this QR code or by using the link in the description below. And it's gonna show you the historical results of the 3-fund portfolio depending on how much you invested in the 3 components, in table and graph, plus a really cool rebalance tool. To know more about the 3-fund portfolio, I'm gonna link the perfect video for you, and you'll find it also in the description below. Tip number 3. Resist the lure of penny stocks. Successful companies aren't born great. They are made. Imagine that by the end of the first decade, 70% of businesses fail, according to data from the Bureau of Labor Statistics. So if you're one of those people that think you're gonna become rich by finding the next Amazon or Apple, scouring through penny stocks, well, think again. I don't know if you watched The Wolf of Wall Street, but penny stocks were exactly what Jordan Belfort was selling. And he was actually selling
the dog shit, the pink shit, the penny stocks, where we make the money.
You're gonna have no financial history, no information, and these companies usually have low liquidity, so they're riskier. Instead, it's much better to wait for a company to prove that they have a long, good financial history. But hey, I'm a nobody. Why should you trust an Italian investor who looks like Manu Ginobili? But maybe you could trust Peter Lynch, which has a little bit more experience than me. Hear him out.
You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money. 30 times your money. 10 years after they went public, they're only in 15% of the United States. You could say, well, why can't they go to 17? Why can't they go to 19? I mean, why don't I take a leap of faith here? Why can't they go to 26? All they did for the next 3 decades was roll it out. You could buy Walmart. If the day they went public, you bought it, you would have made 500 times your money. If you waited 10 years in Walmart, you made 30 times your money. You got plenty of time in this business.
Tip number 4. Diversify your portfolio. In the same interview in 1997, Peter Lynch also said another interesting thing, and that is, if you invest $1,000 in a stock, the most you can lose is $1,000. But the most you can gain is basically endless. Could be $5,000, $10,000, $20,000. So you don't need to be always right, you just need to be right a couple of times. So following the same principle, if you invest in only one kind of asset, or one company, or one sector, you're drastically reducing the chances of getting that one right investment that grows 10, 20 times. And you're also increasing the chances of losing all because you're betting everything on one or a few investments. Spreading your portfolio across different assets, sectors, or companies allows you to hedge your bets and boost the odds that you're actually holding a winner over a long investing time frame. Sectors, for example, are cyclical and perform better in different phases of the economy. So by studying a graph like this, you can actually know which sectors perform well before, during or after a crisis. Value and growth stocks also perform better in different periods. And despite the great performance of growth in the last 10 years, if you calculate the average growth, you find out that value outperformed growth with over 4.4% more per year. And lastly, you have small, medium, and large cap companies. Usually we invest in large companies, for example, using the S&P 500 index, but if you compare the S&P 500 with the Russell 2000 index, which is the main index for small cap companies, since 1979, small caps slightly outperform. Now, you've got your perfect asset allocation. It's diversified, so you can turn on autopilot, right? Not exactly. For example, if you experience a year where tech stocks perform great, like this year, by the end of the year, you're gonna have too much of your portfolio weight on this sector, and maybe too little on value stocks. But I'm not gonna tell you to sell ETFs and stocks every year to rebalance, because it would also mean that you have to pay taxes on the gains. But what you could do is reduce your future investments in sectors that grew a lot and invest more heavily in the others that didn't. So this year, for example, the technology sector went great and the consumer staple sector didn't. So now I'm not investing so heavily in tech anymore. Tip number 6. Mind the fees. There are two kinds of fees that you usually pay even if you're smart enough and decide to invest in ETFs. One is the commission fee that you pay when you buy an ETF or a stock, and one is the management fee that you pay yearly on any fund, and it is a percentage of your ETF portfolio value, the expense ratio. Brokers usually charge around $1 for every trade, so to reduce this, the only thing you can do is actually avoid buying and selling all the time. Instead, be conservative. Invest once a month or maybe once every 2 months, and in as few different ETFs as possible. But what I want you to mind above all is the expense ratio of the ETFs. If you invest $500 per month for 30 years, so $6,000 per year, and your expense ratio is 0.2%, over 30 years you will have paid almost $28,000 in fees, which means that you have lost around 3.7% of your final net worth. Now, let's say that you buy an ETF with 0.6% expense ratio. And 0.6% still doesn't sound like much. The amount that you will have paid in 30 years is now $79,756, which means that out of a total net worth of $734,000, you will have lost 10.86% in fees, not 0.6%, over 10%. So it's always important to look at fees with the right perspective, which is not the expense ratio, but the effect on your net worth. Tip number 7, sell a loser. Tell me the truth. Have you ever fought against yourself because you own a losing stock and you'd like to sell it, but you know that Buffett always says, never sell? Well, while Buffett is obviously right, it's also true that great investors make much less mistakes than us. So sometimes we just need to let it go. Whenever you own a stock or an ETF that is going down and it keeps going down, sit down and take the time to find out what's actually happening with it. And if it's something that the company is not going to resurrect from, you better sell it and get over it. In case of stocks, you need to be able to understand financial statements to find out if the finances of the company are solid. If you don't know how to do this, the first 4 videos that I published in my channel were exactly about this. The quality of the video was kind of ugly, but I put a lot of effort into the content, so if you want, you can check them out later, and I link them in the description below. Now, if instead it's an ETF that is going down for a long period of time, in most cases it's because you choose a sector or a field that had a huge growth in the past and therefore you heard about it in the media. It's not always like this, but in most cases I guess it's gonna be. Look for example at what happened to the global clean energy sector from 2021 to today, a loss of 59%. And why? Not because it's a bad sector, but because only in 2020 it grew almost 140%. What do you expect? Tip number 8, simplify your investing. Now, I honestly believe in this more than anything. I published a video about my portfolio where I show you my 40 positions and I explained that I have so many positions because of my early investing days, where I used to buy stocks like candies at a candy shop. Truth is, the more decisions you have to make, the higher the probability that you're gonna make disasters. So, first rule of simplified investing is invest in common, famous ETFs with a long history of good performance and enough diversification. Second rule of simplified investing, try to reduce the number of brokerage accounts you have. And third rule, automate transactions. You can set up automatic contributions into your investment accounts and also saving plans within the brokerage that allows you to automatically buy a certain amount of an ETF every month at a certain date. Doing this will reduce headaches, and you're also going to profit from the long-term benefits of dollar cost averaging. Tip number 9, don't sweat it over nothing. I don't know about you, but I used to focus on details that are totally unimportant. Like every time I was buying an ETF, I would always use a limit order instead of a market order so that I could get it for those few cents less. Sure, day traders use minute-to-minute fluctuations to lock in small gains. But if you want to invest well, you're going to have to invest for the long term. And believe me, those cents are not going to make a dent. But don't sweat it over nothing also means don't panic over short-term movements of an investment. Because there is no way you're going to make any investment knowing that in the next 2, 4, 6 weeks, the investment is going to be positive. Just focus on the big picture, the long term. Tip number 10, do the opposite of what your instincts are. This is the hardest tip to follow, and I still have such a hard time following it. But it's definitely the one and only true key to successful investing. And instead of explaining to you what I mean by that, I'm gonna let my friend, the billionaire investor Ray Dalio, do it for you.
Do the opposite of what your instincts are. If you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd. So you want to buy when no one wants to buy, and you want to sell when no one wants to sell, right? And that's emotionally difficult, and probably you're not going to play that game well, because it takes a lot of resources to play the game. We spend hundreds of millions of dollars each year to try to play that game well, and it's a tough game to play well. So I would caution you about the market timing game, but I would say that if you're going to do it in the ways that are uncomfortable, because they're opposite your instincts.
To close the video, I'm going to give you another tip that is a bit more specific, but still really useful. It's called tax loss harvesting. Let's say that you have some stocks that have lost value compared to the price you bought them for, and you decide to sell them because in your opinion they are a loser. When you do this, you're going to generate a so-called capital loss. So if you have other securities that instead gain value, before the end of the fiscal year you can sell them, pocket the gain, and buy them again at the same price. And since you had capital losses, the capital losses are going to offset your capital gains, and you're not going to have to pay taxes on them. Alright guys, I hope you enjoyed the video. If you did, consider subscribing to the channel because it's free and hopefully valuable for you. And drop a comment to this video with whatever question, commentary, critique, whatever you want. I wish you a great evening, people, and as always, I'll see you in the next video. Ciao!